Good afternoon. My name is Gad Lebanon, and I'm the head of the Labor Market Institute at the Conference Board. Welcome to a special webcast about the impact of COVID on the US labor market. And in particular, in this webcast, we are going to focus on uh, real-time online job ad data, which is going to add a lot to what we know and understand about the US labor market. Um, I will introduce you to our special guest in just a minute, but let's start with a little more specifics about what we are going to talk about. So one is which industries, occupations, and locations are most affected by the COVID-19 crisis. Uh, what occupations and employers will lead the recovery? So we are now seeing many economies open up and some recovery in some parts of the country, and we'll see where it is coming from. And we'll also talk a little about the topic of working from home. It is now one of the most discussed topics in the US labor market and in US businesses, and not just about what's happening now, but whether the shift to working from home is something that is going to last after COVID is no longer an issue. Um, as usual, we have you can earn some credits by watching this webcast, HRCI, SHRM, and CPE. You typically need to type your full name, email address, and specify the type of credits that you are looking for. And with the CRE, there will be three OK pop-ups that will occur during the program, and please click on them. So today with me is Matt Siegelman. He's the CEO of Burning Glass Technologies and a great partner for our work here at the conference board. For those of you who don't know, Burning Glass Technologies, one of the or the leading company on real-time labor market data, and he has a lot of great insights to share with us today.
Thanks
Welcome,
so much,
Matt.
Gad. It's great to be together.
Great. So we'll hear a lot from Matt in about 5 minutes, but let me take you some of the overview. So we all know that the COVID-19 completely changed the US labor market. Those who listen to our webcasts in the past know that we, for several years, we mostly talked about labor shortages, and now we have the opposite of labor shortages, and will be the opposite of labor shortages for quite a while. And things are happening so rapidly that it's really hard to keep track of the economy using the traditional government statistics and the things that we usually come out within months of reality. And that's why online job ads is such an important tool, because it is something that you can see in real time, really in real time, and it's so large that you can look into specific types of jobs in specific locations and still have a large enough sample to draw important conclusions, as well as you can get information that typically does not exist in other types of labor market data set, especially data on skills that is required, or essentially anything that appears on the ad is something that our partners in Burning Glass are able to extract and classify in some way or another. So we're going to use online job ads to answer some of the following questions that I already shared with you, the industries and occupations and locations that are most affected, and what occupations and employers are leading the recovery, and where we are not seeing a recovery yet. And finally, what we can learn about trends in working from home. So just before we get to online job ads, just to show you the overall condition of the labor market. So that's what we see here is the labor market, the job losses after we got the April job report. And just as a reminder, in this Friday, we are going to get the May jobs report. So it will be curious to see how that changes. But what we see here is the percent change and the number in thousands of job losses by those industries. In total, we lost in those 2 months over 21 million jobs, but in some industries we see a much larger drop than in others. And Matt, any thoughts on like what you think when you see such a chart?
To me, when I look at this chart, what strikes me the most is just how unprecedented this crisis is for the job market. Not only for the scale and scope. I mean, we're all stunned by just how quickly and how precipitously the fall has taken place, but how different the contours are from what we've seen in the past. So, look at this, like 521,000 jobs lost in dentist's office. Now, on the one hand, it makes total sense, right? When there's a pandemic going on, none of us wants to go and have a cleaning done. But on the other hand, that's the kind of job that has always been a safe harbor. Similarly, there's about 259,000 jobs in physicians' offices. There's 335,000 jobs that have been lost in childcare. I mean, like, since when is childcare a discretionary good? So this is a really different recession. I know this is the obvious comment of the hour, but this is a really different recession, not just because it's so big, but because it's having a very different kind of impact from what we've seen in the past.
Yeah, and it turns out that the impact of social distancing is much broader than the amusement parks and entertainment and restaurant. It has a much bigger and wide-ranging impact. So Matt, so this is what we see in employment. What's the general story when it comes to hiring?
So one of the things which is there's good news and bad news here. So we'll start with the bad news. The good news is that we already know it. We've all seen a precipitous decline. Overall, we've seen about a 42% decline in hiring in the U.S. Just since the start of recession. Now, glass is more than half full, right? So it's not that hiring has stopped. There's certainly a different distribution of hiring going on. But as you can see, that after those initial weeks of just absolutely precipitous decline, we've kind of reached, at least for the time being, a plateau. As the old song, when you reach rock bottom, there's two ways to go: straight up and sideways. Right now, we're still going sideways. And the question really is, how fast will we move back up? Will we go straight up? And what's the nature of that? Which parts will go first? How quickly will that come? And hopefully we'll get to explore some of those questions today.
Yeah, thank you, Matt. And I forgot to mention at the beginning that if you have any questions, you are more than welcome to type them in the chat box, and we'll try to take them as they come. Just a kind of, and I know, Matt, you're going to talk in much more detail about it, but I thought this chart kind of captures the kind of jobs that are already we're starting to see a recovery, and those that we don't see a recovery yet. So what you see in those groups of occupation, we looked at the percent change between February and the lowest point that we had so far. And then in the blue bars, we look at the recovery from the lowest point we had until the most recent time. And you can see that, not surprisingly, some of the jobs that relates to personal care and entertainment and travel and food services, they had the largest drops, even up to 80% in some types of jobs. But what's interesting is a lot of those are seeing a strong recovery in recent weeks. Whereas if you look at the bottom, some of the more professional related occupations like business operations and financial specialists, engineers, computer related occupations, health diagnostic and life scientists, there we essentially see no recovery at all yet, suggesting that it either flat or continuing to go down. So, Matt, I know this is a point that you are going to elaborate on, but before we get there, how is the US doing compared to the rest of the world?
So, well, over the last week, outside of the job market, I think there's real questions about the U.S. And how we're doing generally as a society. But as a job market, we seem to be right in the middle of the pack. Not doing as well as Australia, New Zealand, and some other smaller economies, but actually relative to some of the other countries that have had significant COVID outbreaks, we're doing about on par, maybe slightly better in terms of the overall drop in hiring, and also I think in terms of some of the recovery. And you can see that here. It's sort of interesting here we go. Just to map, this is a comparison of the US, UK, and Germany. I know for those joining us today, this is probably almost impossible to read the individual bars. But I think what you can see is that, first of all, this is not a good time to be in the UK. But that overall, what you're seeing here, not surprisingly, is that you're seeing comparable kinds of declines. And in a lot of cases where the declines are happening, in some cases where the jobs are growing, really depends a lot on the sectoral distribution of jobs overall and what the engines are behind those sectors. So, for example, in the US, which is a really developed online retail infrastructure, actually retail, as you can see, has done comparatively quite well relative to markets like Germany or the UK, which have less sophisticated infrastructure. Conversely, societies like Germany and the UK, which have tended to invest more in public administration and public infrastructure, are seeing slower declines in those parts of the economy. And so all of that kind of bears out and makes sense. The real question here is, what is this of the data that we're seeing? And I want to sort of unpack some of what you presented a minute or two ago, Gad, about the kinds of jobs that are recovering and the kinds of jobs that are not, because it says a lot about what kind of recovery we can expect, and how long that's going to take us, and also the kind of impact that's going to have, that's already having and going to continue to have on workers throughout the market. As we know, there's already over 40 million Americans who have been displaced from work since the start of this pandemic. Go ahead, please.
Matt, there are a couple of questions that are already popping up. One, if we go back to the misery loves company slide, there's a question here. How do the numbers here compare to the relative protective measures that each country took to protect citizens that sidelined the economies?
And I haven't looked directly at that. I think from that perspective, the U.S. has obviously spent, the most, not only on an absolute basis, but I think on a per capita basis certainly as well. So the fact that we're coming out middle of the pack is, less than encouraging. It's also been interesting, by the way, to look at the performance of the Swedish job market. That's one where actually originally, again, precisely because they didn't lock down, originally they were sort of top of the curves. They were doing really well, many fewer job losses. And those job losses have accelerated as it's proven out that they've actually suffered the highest death rate in Europe. But I think the question that John raises is a great analysis, which is to say, controlled for how much we're spending to stimulate the economy, how impactful has it actually been?
Yeah, and that relates to the earlier question that uh, do you foresee a similar measure as the $600 unemployment benefit to be extended? If not, how much could the unemployment rate increase? I think, and Matt, you can also share your thoughts. I think it's still a very open question. I think in general, the generosity um, is probably more likely to decline than become more generous of general stimulus, both in terms of direct checks and the unemployment benefit. So I would be surprised if this level of generosity sustains more than a few more months. But Matt,
I
any
think
thoughts?
the real question is what's the form of further investment in those who've been displaced? There's a bunch of open questions, and certainly, Gad, you're more expert at this than I about what works best and what kind of impact extending unemployment benefits has. Certainly, there's a lot of people in trouble right now and need the help. Beyond these first couple of months, though, the real question is what works in getting people back into work. And some of that is temporary support, but a lot of that has to do with how we help people invest in themselves to acquire the skills for the jobs of the future. We'll talk a lot more about that later. And so let's actually put a bookmark in that because I think the
Hmm.
relevant question to me, which is how do we help people invest in themselves and give the kind of support that's not just helps them keep food on the table for their families, but helps them get back into the job market. One of the really tragic things that we've seen from past recessions is that a lot of people, once they're displaced, struggle to get back into the market and to achieve the kind of mobility that they were enjoying beforehand. And so I think that
Yeah.
the real question is what kind of support we can offer to help people acquire skills.
Yeah, no, I think that's an excellent point. I think in, for example, men without a BA, they saw almost no recovery, even in the 10 years of expansion that we had. Their labor force participation barely increased at all, and the share of men aged 25 to 34 who live with their parents just kept growing to the point that almost one quarter of men between the ages of 25 and 34 without a BA live with their parents, and now with this crisis striking, it could continue to grow even further. So, Matt, I am trying to remember. I think we were
And that's
here
great.
before we took some.
And this actually
Uh,
sort of connects directly to that question, right? Because historically, if you had a college degree, that really kept you safe. And there was a really significant difference in the last recession between the unemployment rate of the college educated versus those who didn't have a degree. And thus far, in terms of unemployment insurance claims, that's proving out here again as well. But if you look at job postings as a indicator of what may be coming down the road and how companies are investing, what we're seeing here is actually a very unusual trend and actually one that's quite disturbing, which is that actually job postings have dropped much faster and further for those with a college degree than for those with a high school diploma, actually by a 13-point difference, which is a
mhm,
very unusual pattern, which we haven't seen before. And that bears out as well in what kind of opportunity there is for people who are coming out of school. I think a lot about the class of 2020. A lot of companies have had to pull back their offers to new college grads, and you can understand where that's coming from, given they're already laying off a lot of people. They're certainly not going to add in new graduates who need a lot of training. But as a result, you can see that that 51% share that we saw before overall for college degree jobs, 51% decline, translates into a 57-point decline for entry level college grad jobs. So that's a very significant question for what happens to students who graduate into this kind of recession. One of the things we know from our research is that even in the white hot job market that we've been enjoying up until now, 43% of students, of recent graduates, graduate into a job that doesn't require their college degree. And most of us kind of have this view that, okay, well, they'll figure it out. It's not a big problem. And actually, our research has shown, from studying millions of people's career trajectories, that the people who start out unemployed are likely to stay unemployed, or underemployed, rather. The people who are in a job that doesn't really take advantage of their degree, a high percentage of them never get back on track. So a lot of what we have to think about here is how we can make sure that we're supporting students to make the right kinds of transitions. And again, we'll show you some examples of some of the things that may be paths for them to climb back up in minutes.
Yeah. No, that's, I think the new entrance is an excellent point, and I think there is kind of a double whammy for new entrants now, because not only every recession is particularly bad for young workers. We see typically in a recession the unemployment rate for young workers jump much higher and much more than for older workers. But in this recession in particular, it is concentrated. The industries most impacted have an especially high concentration of younger workers, especially food services. There are types of jobs where 70% of certain food services jobs, 70% are occupied by people under the age of 25. And so there is a stronger concentration than in a usual recession. So those young workers are likely to suffer more than usual.
I think there's another point there too, though, which is that look, when you're in a pandemic and all of a sudden the bottom's dropping out of the market, it's the things that you continue doing are the things that involve daily operations. And actually, we'll see in some of the next slides that's perhaps again more concerning is that on one hand it's more understandable, but it's also concerning that employers are also pulling back because they may be continuing to operate. They may be hiring for people who are undertaking the daily operations of a company, but they're pulling back from innovation. And so this also goes back to both the opportunities for the college educated, but I think even more broadly here, this is an example. This is a set of jobs here. And by the way, there was a question here what these declines are, what period we're seeing these declines. These are from March 2nd through middle of May. Tracking the specific time period of the pandemic. And it's looking at the decline in hiring for occupations that are really sort of involved in innovation, right? If you're an airline and you stop flying, you lay off flight attendants. That makes sense. It's unfortunate for the flight attendants, but you kind of get it. These are jobs whose output is not about what the company is delivering today. These are jobs like software developers, like product managers, like engineers of various stripes, whose output is really going to be measurable not in Q2, not in Q3, maybe not even in Q4, but in 2021. Right? If I stop hiring software developers, then I'm not writing applications that I might release next year. And so this says something about how how American industry is pulling back, and about the potential long-term price that we may pay. When you stop investing in innovation because you're afraid of a recession, that pretty quickly becomes a self-fulfilling prophecy. And that's something which we're seeing here. That also bears out, by the way, in their hiring around management roles. So again, the kind of roles that have tended to be safe, and I'll break some of these out in a minute, but overall, again, we're seeing an average decline across the market of about 42%, but that's 56% decline in hiring for for management roles, sort of professional college level management jobs. So things like financial managers, information system managers. You can see here that things like marketing managers down about 60%, and the list goes on. So this is, again, a very unusual pattern, and it speaks to just how much industry has stepped off the gas in terms of its investments in the kind of roles that up until a couple of weeks ago, a couple of months ago, were really premium talent and hard people to land.
Yeah, no, it's really interesting that this survival mode that many companies are in may make them survive, but it does have long-term implications in terms of investing in 2021 and 20 and beyond. Yeah. So, and we see that in IT probably more than any other type of innovation, no?
Yeah, that's one which is particularly surprising because it's been so white hot. In this case, actually, I've looked at specifically at IT parts of the tech spectrum as opposed to software development, just with the notion that, look, we're having this conversation not we're not sitting next to each other in a studio and at the conference board in your great facilities, but actually we're doing this online, as is everybody else around the country and around the world. And so you would think actually that there would be, as we anticipate, an economy where that's a lasting impact, where there's a growth of what we call the remote economy. You would expect there'd be more investment than we're seeing thus far in tech, in the technical infrastructures to support the remote economy, and here too, seeing significant declines. Now, in terms of what spurs reopening, or what I should say spurs recovery, there's been a lot of hope that, and early on at least, I think there was a lot of hope that we could flip the switch. People would come out of their bunkers, spend lots of money, and everything would go back to normal. And certainly what we're finding is that reopening helps. What you're seeing here is took the states, divided them into quartiles based on their reopening date, of the reopening date specifically for retail, and look at what kind of posting growth they've been seeing over the last couple of weeks. So now this is not looking at since the start of the pandemic, but just over the last couple of weeks since a number of states have started reopening. And what you're seeing is that the states that have been earliest to it have been seeing some more growth than others. Overall, there's been 11-point spread between the earliest opening quartile states and the latest. But fundamentally, that's when you're talking about an 8% up from being 42% down. That's not that surprising. And I think also very important, the specific places where we're seeing that kind of activity, a lot of it is, as you pointed out before, Gad, is around things like accommodation and food services. It's about real estate, other kinds of things there was a lot of pent up demand, and where it's very proximity based. And, you can see that here, right? So, okay, look at some of the roles that have really been bounding back the most. Okay, well, 162% growth in demand over the last couple of weeks, of the last 3 weeks for hairstylists, 100% growth for phlebotomists. Okay, great. I didn't want to have a blood test taken if I could have at all avoid it. They're the dentists again. So all those things make a lot of sense. There were some other interesting things that we also saw that have started to pick up. And we look at these kind of green shoots in the economy. What are the stems that are starting to pop up above the soil? One of the ones that was surprising was around finance and insurance. You can see those are in green on this chart. So insurance sales up 54%. I guess a lot of us have looked mortality in the face and want to go out and buy life insurance or something. We can see demand likewise for tellers and loan officers and a bunch of other kind of fields like that. And so it's been interesting to see that finance and insurance has been one of the leaders in recovering. Similarly, actually starting to see some green shoots in manufacturing. Manufacturing has been hit hard in this crisis, and so good to see some of the key roles within the manufacturing economy starting to pick back up.
Matt, if I may comment on the manufacturing, I think manufacturing, on the one hand, we are seeing some recovery because in many manufacturing plants were simply forced to shut down and nobody could work there. But from other sources, we get the sense that a lot of pain is still ahead of us in manufacturing. It's a very cyclical industry that tends to go down when the rest of the economy goes down. So, for example, in one of the surveys that we did, manufacturing more than any other industry still projected more layoffs coming down the line. But it's certainly a better situation than you can't simply go to work because your plant is shut down.
Yeah, no, I think that point's a really good one, which is that in some ways the kind of there's an open question still whether this recovery, the recovery that we're seeing for some selected manufacturing jobs is really just something. I mean, it's essentially just like the proximity-based jobs. Can't work in a plant if you're not at the plant. The plant was closed, as you point out. And that doesn't mean that manufacturing is safe. As if we are in a protracted recession, manufacturing, exactly to your point, will suffer. What we are seeing, again, this is, we've talked a bit about this. You pointed this out before, Gad. It's actually not just that we're not seeing any green shoots in tech or in management and business occupations and in operations occupations, but actually quite the opposite. We're seeing that those kinds of jobs are continuing to fall, which is alarming. So you can see that ranging from a 10% drop over the last 3 weeks for network administrators all the way to just over the last 3 weeks, a 49% drop in demand for marketing managers, 43% for financial specialists. So we're really seeing, I wish I could say that while the economy overall has reached rock bottom and maybe still moving sideways, there are still a bunch of very important economic engines within the economy that are still falling. So the question, this is where I wanted to come back to the question that somebody had asked before about, what are the right kinds of investments that we need to undertake? How can we support workers most effectively? Now, I think it may sound obvious to say that the most important thing to do for a worker who has lost her job is to help her get a new one. But as obvious as that may sound, it's not always necessarily what we enact in policy or necessarily what job seekers do. A lot of people hold out to try to find a really good job. If you're on the Titanic in the middle of the North Atlantic and it's going down, you want to get into a lifeboat. And the longer people tend to be out of work, the more likely they are to drown, right? So, and we talked about some of the real tragedies of the last recession. So, what we've been spending a lot of time looking at is what are those lifeboat jobs? What are the jobs that are either have been growing over the course of this pandemic, or that at least are seeing less of a decline? But then the question that I think is at least as important is this, because a lot of people, to be fair, in past recessions got into lifeboats, but they never got out. Again, if you're in the middle of the North Atlantic and you're in a lifeboat, you're not going to make it to shore in a lifeboat, right? So the real question is, where's the rescue boat that you can row toward? And so the real question is both not only how do we help people find immediate employment in jobs that may be a step down, but then how do we map a step back up? And then how do we support workers to gain the skills that will enable them to climb back up and to achieve mobility again? Here's an example of somebody who maybe, let's say, is a software developer, loses her job, takes a job as a network support specialist or something like that, which has seen a slower pace of decline. What are the sets of skills that she's going to need to be able to get into the lifeboat? But then more importantly, where can she step up to? Well, from a network support role, you can actually step into some very high paying roles, whether it be an information security analyst role, whether it's whether it's a database administrator, whether it's a cybersecurity role. How do you isolate the specific sets of skills that you would need to move from one to the other? One of the problems that we've often seen with retraining programs in past recessions is they assume that somebody has to start from scratch for a new job. And so that means that you're staying out of the market for a long period of time. That means that your relevance is going down very fast. The longer you're out, the less relevant you are, the more askance or more likely it is that employers are going to look askance at you and your experience and question your relevance. And also the more expensive it is from a retraining perspective. I have to train you up from scratch. And one of the things that we've come to realize in some research that we've done for the World Economic Forum and BCG is that you can actually isolate the specific skills that separate somebody in one job from the skills that they need to be into the next job. And you can design training that is intended to only train for that skill delta, if you will, for that to help people bridge that specific gap. That makes retraining efficient. It makes it lower cost and it makes it quicker. That's important, by the way, within your own workforces for those who are in the human resources domain. How do you make sure that you can redeploy talent that may be excess capacity in your current organization for roles that are high demand? And it's also something that we can use to support workers who have actually been displaced, as in this example. And by the way, here's just another, a whole bunch of different jobs that are lifeboats across the spectrum. Importantly, by the way, the availability of lifeboats varies a lot based on geography. One of the things you'll see here is this middle column, which is the states with posting increases. So even some of these jobs that have been lifeboats, things like shipping clerks and drivers involved in making sure that we can all bunker down at home and live off the internet, those aren't up everywhere. And so it's important to sort of take stock of the specific opportunity landscape for workers in economy by economy.
Matt, there was a clarifying question here about the typical wages that are shown here. Are they from the BLS or are they from the ads that you collect?
These are from the ads that we collect. We've and ads are actually a very interesting, particularly in this kind of scenario, because they provide not kind of the average worker working in that field, but they are they're what's being advertised. They're more likely to be reflect the starting offer or the starting pay, if you will, for someone in that field. So it's we think a really good way of trying to look at transition, because it anchors the expectation. Often people have, and this is another encumbrance in past recessions, is that a worker might be in a relatively low paying field, but she's worked there for 20 years. And so she's worked her way up to a salary range that may be higher than her skills might otherwise suggest. And so when she has to make a transition, you have to look at not the average employed wage, but you have to look at what's the starting wage that's being advertised.
Mm-hmm. Yeah.
So one of the things, sort of, this is the converse of the point that we were just looking at. So obviously we've talked a lot about how hiring is off in a lot of fields, but this is also, I think, a really important moment for employers as they think ahead to recovery. And even if recovery, it's hard to see recovery at this point in the trajectory of this crisis. One of the things to realize is this, that the people who have been displaced aren't necessarily the people who get rehired. And so as companies are thinking about who they wind up hiring back, inevitably, what a lot of employers are going to wind up doing is thinking about what are the skills of the people who are working in those roles in the past. What are the skills that I'm going to need for my future workforce? You're seeing here an example of across a range of jobs. We've called out some of the skills that are what I call premium skills or differentiated. These are skills which have traditionally been harder to find, skills which command significant market premiums. Now, we're in a slack job market, and so even if those premiums don't hold up, this is a good indication of the kinds of skills that have been rapidly growing that we can expect to be the kind of future-ready skills that you want your workforce to have. So as you add back in industrial designers, for example, picking ones who have information architecture skills or usability testing skills are important. As you add back in software developers, those who have cloud and infrastructure as a service skills and AWS cloud formation and those kinds of skills are ones that you haven't been able to get in the past. These are the sets of workers who you want to be looking for, because this is an opportunity to, in a broad scale, where the recovery will be in a significant opportunity to pull back in workers who have the kind of skills that are going to define where your organization needs to go into the future. You can see that here too at a skill level. Thus far, all the analyses that I've been showing you have been at the job level. But here you can look at the decline in demand for a range of high premium digital skill clusters. And again, one of the things you're seeing, first of all, is that, and this is surprising because these have been skill sets like cybersecurity skills or data mining skills, data visualization skills. I mean, it's so hard to acquire over these last few years. And suddenly there's more of a fall off in hiring for these sets of skills than we're seeing in the economy writ large. So that's bad news for people who have those skills, at least in the immediate term. But you have to step back and say, do I think that there has been a fundamental change in the fabric of American industry? Will American industry become less dependent on data tomorrow? Will American industry become less digitally enabled? To me, the answer to those questions is pretty obvious no. And so if you think that we're not seeing a fundamental change, that we're seeing a pullback from hiring while we await recovery, this makes this a perfect opportunity for those who are in a position to be buyers of talent to go and buy. Because you're going to see slack demand and therefore more supply of people in jobs or with talent sets that have been very hard to acquire in the past. So figuring out what are those sets of skills that are most critical to your future as a company and using this as an opportunity to bulk up on them, to acquire the sets of talent that you've not been able to get is a great opportunity.
There is a question here about the training dollars needed for retraining in the midst of all of this shifting. Do you think companies will find the money to train?
So I think it's worth dividing up the world of retraining into private sector and public sector. So I think what we've seen from our analysis, we did some analysis about a year or so back, looking at, again with BCG and the World Economic Forum, looking at jobs that were likely to be significantly automation impacted, displaced by robots, all that kind of stuff that we've all been worrying about, and actually seeing, in some ways, what we're seeing in the COVID crisis is an acceleration of those trends. So it's a good proxy for this. What we found is that employers by themselves get a positive ROI about 30% of the time. So for 30% and transitions that they can invest in, just without any kind of subsidy, employers can get a positive return on investment by undertaking that kind of retraining. When you sort of take into account, how do I move somebody from a job that where I no longer need them into a job that I've been really struggling to fill and that usually pays a lot more? There can be significant opportunities to arbitrage in your own workforce. We all remember from Economics 101 that arbitrage thing of buy low, sell high. I can take somebody who was making $60,000 a year, let's say a graphic designer, and I can move her into a web design job that's paying in the mid 80s. That's maybe I split the difference with that worker, but that's an arbitrage opportunity. And so you can see positive ROI some of the time. When you look at public-private partnership, if you start looking at, well, what can the federal government or state governments do to support industry, perhaps, and to support workers, perhaps instead of additional blank checks of stimulus, we think about how we create incentives for that kind of reskilling and retraining, then the demand shifts. It's also relevant where your geography is. Right? So if you think about how this bears out in Europe, for example, where there isn't always the flexibility to just let people go because you don't need them anymore, where there's more of a social contract of employment. The need to be able to think strategically about reskilling is really important. Again, I want to turn over to you in a minute, but I just want to provide, I know we're planning to do a second installment of this. We've been talking about what's going on thus far, and I think in a few weeks' time, we'll talk a little bit more about what comes next. So I just wanted to give a little bit of a preview of some of what we've been studying thus far. We've been tracking a couple of core drivers of where we think the recovery, of some of the forces that we think are likely to shape a recovery. One of those is is what we call the readiness economy. Thomas Friedman talks about, a lot of people talk about COVID-19 as a black swan event. He talks about it as a black elephant event. It was the elephant in the room that nobody paid attention to. And pandemic isn't the only black elephant that's out there. All of a sudden, we can up and paying more attention to the potential for things like environmental catastrophe, for network vulnerabilities, for cybersecurity attacks and the like. And so I think you start to see a lot more investment in those. There's a set of jobs and skills that underlie those. Similarly, we're having this conversation remotely. What are the jobs and skills that support a remote economy? What are the jobs and skills that are distributed by a remote economy? A lot of people are talking about diversified supply chains. We talked a minute ago about the acceleration of automation. And so I'm looking forward in our, down the road to laying out what we think the data tell us about the drivers of that recovery.
Thank you very much, Matt. And we will advertise this webcast soon. So those of you who want to join us for the second round are more than welcome. I just wanted to show you a few things and kind of examples of other stuff that you can get from online job ads. So one thing we wanted to see, how is the drop and the recovery vary by company size? And here to kind of estimate for or proxy for company size, we looked at the typical number of ads those company have, and you can see the different colors refer to different typical number of ads. And I think one thing is the smaller the company is, the more likely it is to completely stop. In the top panel, you see the number of active employers by company size, and the smaller the company size is, the more likely it is to stop publishing any ads. In the bottom panel, you see the number of ads, and in both cases, March 1st, or I believe March 1st, the 4 weeks ending in March 1st, so essentially February is equal to 100. So you see that, perhaps not surprisingly, that the smallest group, the one that typically has between 0 and 1 ads, they drop the most, but they are the ones that are recovering faster. I guess many of them simply laid off all their workers, and now they need to start from scratch. But what's interesting here is that that many of the large companies, as Matt pointed out to me before this the webcast, that most companies continue to hire even in very tough times. There are a lot of churning, people retiring, people stop showing up for work for various reasons and need to be replaced. and there is a lot of hiring anytime in the economy, and especially the large companies, they are continuing to hire more. But we are now seeing in this recovery part a stronger recovery in the smaller companies. Also, a nice feature of this data set is that you can look at information by company. So those are some of the companies that significantly increased their number of ads. Not surprisingly, some companies like DoorDash and Instacart, that's not on this, they had a huge increase in the number of ads because they need to find for all those home deliveries. Also, Amazon had a very large increase in the number of ads, and some supermarkets and fast food restaurants that are also doing a lot of deliveries. You see a very large increase there. Then in the next slide, you see some of the um, companies that almost disappeared from the labor market, but now they are showing a strong recovery. Not surprisingly, some Holiday Inn, so a lot of hotels are now starting to hire more. Food services and also retail is starting to recover as the states open up. I think in terms of one thing that is also important and online job ads provide a lot of insights on is specific areas. So, when you think about which areas, regions, or countries are going to be most impacted, you can think of some factors that will impact that answer. So, first of all, how much they rely on the most impacted industries. So, vacation destinations you would think are probably going to be impacted more than average, and Las Vegas in the US probably more than other metro area, Thailand, Monaco. Because of the large drop in oil prices, or areas that focus a lot on oil production are also going to see a larger drop, the same way we saw in 2015. Also, the magnitude of the spread of COVID-19 and how difficult it will be to contain it are also probably going to impact the recovery. In New York City, for example, going back to normal means that 30% of all workers are using the subway again, and or other public transportation, and that may be more difficult to contain the spread of the virus when everyone is back on public transportation. So we'll probably see large differences in that dimension. Also, the share of older population. We know that this virus is more dangerous for older people, and that means that they are probably going to suffer or experience a longer and more extreme social distancing period. And so areas that rely more on older population may see a bigger drop in spending, for example, Florida. I want to show you this map where we talk about we're trying to estimate the areas that are more impacted by the most impacted industries. So you see a lot of vacation destinations here, Las Vegas and some in Florida and the other places on the Atlantic Ocean, and some oil destinations as well. Those are areas that are likely to experience more layoffs and less spending. And I may have missed here. I thought I had a slide here that shows apologize for that. But I had a slide that somehow disappeared and showed that indeed in vacation destinations, we divided all metro areas to certain groupings, and vacation destinations and college towns. Those are two location groups that saw the largest drop in online job ads. but there we are also seeing some recovery. So kind of the ability to drill down to specific locations is also something that online job ads provide us. Finally, I wanted to talk about the topic of working from home. And one of the things that the data set allows you is Burning Glass is able to classify whether a job ad is indicating work from home using various keywords and phrases. And we do see a huge jump in ads that indicate work from home. So what we see here in the blue bars, this is the average for February, and the orange bars are for the last 4 weeks. And we see a big jump in most office related jobs, more than doubling, in some case tripling of the number of ads that point to indicating work from home, but not everywhere. So in some office jobs or office related jobs or professional jobs, we see much less of that, like in education, life, physical and social sciences. Probably in life and physical sciences, you need to be in a lab, and it's not something you can do primarily from home. Also in engineering, there is relatively less, and healthcare. So, but in the more pure office related jobs like business and financial operations, legal, and office administrative support, we see a very large increase in the share of working from home. And that relates to a survey that we did, where we asked, we did a survey among over 150 HR executives, and we asked about the percentage of respondents that expect an increase in full-time employees working primarily from home. And we see that there's been 77% among all companies, and companies that mostly employ professional and office workers. In the black bar, we see that's an 83%. And the magnitudes are very large. In the bottom part of this, we see that the share, that the expectation of what percent of the company will work primarily from home. So it's going from less than 20, less than 10, 10 to 20, 20 to 40, and 40 and above. And we see that expectation of 1 year after COVID subsides, there's a huge increase in both the share of, say, 20 and above and 40 and above. So a much larger share is expected to work primarily from home in the long run as well. I think we are almost running out of time. I wanted to give you a chance to see Matt's email address if you have any question for him. Matt, thank you very much for participating in this webcast. It was great insights, and we will do that again soon. Just before we conclude, I just want to mention a few other things that the conference board is doing related to COVID. There are all kinds of webcasts here that you can see, and also we have podcasts for those who also like podcasts. So there's the Indications. It's a podcast series of our Economic Strategy and Finance Center. Also, there we have a dedicated web page divided to COVID, where you see everything we do related to COVID is in there. And finally, I think just if you have a minute to fill an evaluation form for us, a webcast evaluation. And I want to thank again Matt and everyone for joining us today, and have a great rest of the day.
Yeah, this was a lot of fun. Thanks so much.
Bye.